Thank you, everybody. I really look forward to this opportunity to have the opportunity to speak with you all and be here at the conference. I'm going to be asking Brian Beaulieu to come out, and for those of you who don't know Brian, you probably should. Brian works for a firm called ITR Economics, and what they do for their clients is they use economic indicators and trends in order to forecast upcoming market corrections so that their clients can make sure they have investment strategies that preserve and increase wealth. Some of Brian's work, notable work, which there's a lot, but I'll talk a little bit about some of it. Brian wrote a book called Prosperity in the Age of Decline, which again, if you haven't read it, pick it up. It's a great read. In that, Brian's group was one of the groups that saw the financial collapse of 2007 and 8 coming, and in late 2016, advised all of his clients to move out of risky real estate investments, which then saved them untold amount of wealth. Brian also, in his book, which was published in 2014, accurately predicted the GDP growth for 2015, 16, and 17 within 1/10 of 1 percentage point. So why is this interesting to all of us? Because everyone here, whether you're a private equity player, you run an investment fund, you're an asset-based lender, you're all here and we're responsible for creating investment strategies that perform well regardless of market conditions. It's our responsibility to make sure that we're getting accurate information and making sure that our portfolios are aligned in a way that will minimize downturns and increase opportunities for upticks in the market. At Second Wind Consultants, we work with distressed small businesses and mid-cap businesses all over the country and we focus on reorganizing those businesses, preserving the underlying value, and streamlining the short sale process. And what we focus on is eliminating excess debt. And when we do this, we solve a problem that is common to almost all distressed investing opportunities. The obstacle to closing or the obstacle to a successful investment is too much excess subordinate debt. So our process allows us to create a solution for that, and that creates a lot of value for both asset-based lenders, private equity groups, but more importantly, it preserves the underlying economic value of that business and the jobs and the multiplier effect that that has from that industry. And that's really our context. We believe that we are responsible for making sure that we preserve as much economic activity, so on the macro scale, one deal at a time, we can move the needle in the right direction, one deal at a time. So with that as our context, I want to introduce and bring out Brian Beaulieu to talk to us about what we're going to see in the upcoming years. Come on out, Brian. So Brian, do you have any opening remarks for the group before I start peppering you with some questions?
Just that I think you all are going to be very busy in the years ahead. There are tremendous pressures coming upon businesses from within and without that, by and large, so many of them are not ready for. You are going to be very busy in this space for a good number of years to come.
I suppose that's a good thing.
It is for this group.
So Brian, let's start at a very high-level question. Explain to me in your own words what you perceive the business cycle to be and why you believe so many companies are late to acknowledge the cyclical nature of growth.
A compound question. The business cycle occurs because imbalances develop within the economy, and these undulations are just a normal phenomena. I think a lot of businesses are slow to understand that and accept that because when they're young, particularly I was thinking about it in terms of aerospace, Adam, these small and mid-cap businesses, some of them still have the founder in charge. When they're young, within the first 7 years of any corporation's life, really, there are no cycles. You're out there every single day grabbing market share, growing the business, garnering every dollar that comes floating by the front door. You're making the growth happen yourself. But as you grow, you become more and more dependent upon the economic system. And that's a transition that too many business leaders fail to make. And even when they get to be a good mid-sized cap business, I find that ego sometimes come into play. I remember, well, there's a whole host of examples I can give you, but I remember one in particular where we went in and we said, your markets are going to be down 12% next year. What are you doing to prepare for that? What's the plan B in case we're right so that you can protect the bottom line of your company? And this person has surrounded himself with a great deal of young talent, and they said, we're just going to grow through it. We're going to gain market share. So we said, that's great. How are you going to gain market share? What's the plan here? So we're just going to gain share, that's all. Like it's right out of a textbook or something like that.
You find it on the floor, I think.
Yeah, you find it on the floor sometimes. And the next thing you know, that CEO's out, and he's no longer invited to board meetings, shall we say, and there's new management in place, and this company is restructuring. It's not that business cycles destroy your business, it's being unaware of them and the pressures they bring upon your business that ultimately create these distress situations. And there are some tells that you can look for along the way, of course, but generally it's success in the past breeds linear thinking going forward, and they don't see the bends in the road that are inevitable in our economy.
So let's talk about some recent historic examples and what you think, if anything, could be done to have alleviated them or avoid them altogether, whether that's the dot-com era or the 2007, 8, 9. Is there anything that could have been done to avoid the situation, or is it just about weathering the storm?
There's always something that could have been done to avoid the situation. The issue is, though, it's never going to happen. So I don't really delve into the woulda, coulda, shouldas of those downturns, just like we know what's driving some of the major problems we have in this economy, what's going to drive some of the long-term pain that we see for the U.S. and the global economy. But there's no need to go there. You and I aren't going to fix these macroeconomic problems. The best you and I are going to do is take care of our firms, our families, and position businesses so that they can weather the storms and make money even when those around us are not making money. I am a capitalist to the core, and the number one objective is for us to make money through good times or bad, and there are always ways to do that.
Great. So what do you feel the largest threats to corporate solvency in the U.S. are currently?
I think the largest threats are in their rearview mirror. They have no experience dealing with the margin pressures that are coming upon us. We're not used to living through a prolonged period of shortage of labor. We're living through a long period of supply chain disruption. None of us have actively dealt with the global trend toward nationalism that is currently underway. And we don't really understand all the ways that that's going to impact our businesses, impact our margins, and allow us to continue to prosper. We haven't defined in many instances what the competitive advantages of this entity. What makes it worthwhile for somebody to use my firm as opposed to somebody else's firm? It isn't because I've been here the longest. It isn't because we're the safest, that we're the nicest guy. There's a competitive advantage that is not being articulated. All those issues come to bear in terms of why people are now saying, well, where's my margin going? They get a temporary tax break from the government that helps. You know what the government gives, the government can and probably will take away at some point in the future.
Yeah, at Second Wind, we've seen a lot of increase of the use of leverage, even after acquisitions happen. There's a lot of use of leverage, which increase fixed costs and therefore leaves less variability for shifts in variable costs. So along those lines, I don't know if you've seen this in a lot of your forecasts or analysis, but have you seen rising fixed costs and then leaving less room in margins for variable costs?
For firms that are operating on a fairly tight lane of profitability, what you describe is going to be very painful and a very difficult road for them to go through because there aren't enough reserves. And those are the folks that our attendees here are looking for. There are plenty of companies out there that are leveraging the future and doing so very successfully. These interest rates are incredibly low right now that we're experiencing. They're only going to go up in the future. There's more inflation in our future than we've seen in the last 20 years. And that means interest rates, while they're taking a hiatus here in 2019, they are going to be going up. So if you're going to leverage, now is the right time to do it, but at the right interest rate and under the right circumstances, and people are doing it under the wrong circumstances and because they have to, not because it's the right thing to do. For well-managed, profitable companies, my admonition to them is this. They say, how much money should we borrow? And I say, if you're sleeping all the way through the night, you have not borrowed enough money. But you've got to make sure that you have a roadmap of how you're going to pay that back. They have more than just a 13-week pro forma for cash flow, and you know how this is going to pay itself back because the business is growing that rapidly that you can afford that increase in costs.
Great. What industries do you believe are aligned to handle and even potentially thrive in upcoming changing market conditions?
I think you have to look for industries where the R&D supply line is well established, and maybe a distress situation is going to come along where this particular player hasn't been partaking in that movement, and they're the ones that are being disrupted by the technology rather than adapting the technology or utilizing it to go forward. There's industries that I think are safe and therefore probably not particularly worthy of you unless they are under bad management currently would be food, beverage, security, all sorts of security, logistics, facilitating international financing. Those sorts of fields are going to be wide open, and for companies that know how to execute very well, very profitable fields.
So in your book, you make a variety of projections about upcoming market corrections. Can you talk about what you see the next recession being, the when and why?
Sure. Right now, the economy is slowing down, and that alone is going to create some stress for a lot of companies because they were buying into the tax cut change, the change in our accounting for CapEx, et cetera, is changing the ball game, and it changed essentially nothing. I mean, the positive impact of that nitrous oxide being applied to our economy is in our rearview mirror. We're going back to normal economics, and the leading indicators globally are very clear. The whole world is slowing down, and we're slowing down with it. And as you slow down, including in the consumer retail areas, some parts of the economy are going to crack, and you'll see some actually contract. That is going to come up. You'll see more of that in the second half of 2019 and the first half of 2020. That's really going to be the sweet spot for some opportunities to strike in terms of distressed management opportunities or distressed investing opportunities. What's driving that is simply the liquidity that was out there has been deployed, and now there's this, it's almost like a fear factor that's being put up there. There's too much uncertainty. We're seeing China is withdrawing in terms of their ability to grow, and that's a permanent phenomena, by the way. That's not just a today phenomena. We're seeing the U.S. businesses taking a breather, trying to assess what all this is going to mean down the road. And once that slowdown starts going, it gathers its own momentum until something else turns it around. I think we're all going to start feeling much better about the future when the Federal Reserve takes their foot off the interest rate gas pedal and just allows interest rates to stabilize. And clearly that's what the marketplace is telling the Federal Reserve to do. When the Federal Reserve says they're going to have patience in 2019, all they're doing is reading the economic tea leaves, the same ones that I read, and the marketplace is already telling them, back off on these interest rate increases, no more. And the stock market clearly is looking at forward valuations based on profitability trends, and they're not liking what they see. We're going to have to get through those two issues first before we start seeing the turnaround. I already have 3 leading indicators, empirical leading indicators, telling me that the economy starts to rev up in the second half of 2020. You mentioned our track record. Thank you very much. One of the reasons for that is we've developed very long-term empirical leading indicators. And they're telling us about the second half of 20, and in 2021, the economy is doing much better. We're back to running on all 8 cylinders. So, but to your question, we see the next danger period for the economy being 2022 on into early 23. And the exact causes of that are always difficult to nail down at this particular junction. But if I was going to speculate on the whys rather than the probability of its occurrence, it would be because the Federal Reserve will be back to raising interest rates in response to heightened inflationary pressures. It will be because too many businesses are not equipped for the global nationalism and its impact on margins. It's because they haven't automated fast enough and are still relying on hiring more people than finding an alternative way to grow their business without people. So margin compression becomes pretty extreme, we think, in 2022, and you'll see a general reset occur during that period. Just FYI, right now, everything that we're looking at my firm, we think 2022 is going to be the worst year any of us in this room will have seen the economy go through since 2008. It won't be that bad, but it will be the worst cycle since 2008. And it's going to be a wake-up call for a lot of people.
So without giving us your secret sauce, tell us about those indicators. What are you looking and tracking that leads you to that conclusion?
You're asking me to describe my secret sauce to you, Adam, and I like you a lot, but you haven't bought me nearly enough flowers and stuff for me to do that. So
we can any macroeconomic indicators that are like just screaming out at you, though? Not all of them. Is there one that is at the top of your pile that is the most concerning?
About 2022?
About 2022.
Yeah, the global inflationary pressures. So much fiat currency was created coming out of 2008, 2009. We haven't seen the full ramification of that. That's the biggest macroeconomic concern I have. The other one, it has to do with the U.S. government's seemingly insatiable appetite for debt. We're setting ourselves up for a very interesting dynamic because at the same time we're becoming very difficult trading partners to the people that are lending us money. We're going to have an even greater need for them to lend us more money. That's a dynamic that is not setting us up for success. And I think we'll feel some pain from that in 2022 as well.
Do you have any indication of which sectors you feel might be hit first or most on the largest scale?
I think the way we're looking at that 2022 cyclical decline, you look for the traditional markets to be the canary in the mine. That would be housing, the stock market. Then you go into the consumer discretionary side of things, the automobile retail sales. You'll see the fairly classic domino effect occur. Keep in mind when you're doing that, if retail sales, which we all track, follow the normal progression, it won't go negative as your tell. The tell isn't retail sales going negative. The tell is when retail sales in nominal dollars is not growing more than 3%. And when it's clearly slowed down to a 2.5% retail sales growth, nominal dollars again, then you're looking at an economy that is stalling out. And that'll be one of your major signs that, oh, here we go again. People will still say, well, at least it's still growing. It could be worse. That's not the point. The point is it's not growing enough to keep our economy growing at large.
So going back to the tax stimulus, which is, I guess propping up a lot of companies at this point in time, do you feel that there is still some residual stimulus effect? And if so, do you know when you expect that to run its course, or has it? Is it in our rearview mirror?
The data that we are looking at suggests that it is indeed in our rearview mirror. One of the long-term factors we look at in that regard is we looked at business gross investment as a percent of GDP. We've been looking at that for over 40 years, almost 50 years now. And it vacillates around a very narrow band of 12% of GDP. Good times or bad, you're not going to see much deviation from that. It's the independent variable is GDP, not our amount of investment. And even during the Reagan tax cuts, we did not see an appreciable deviation from that 12%. And during the 2018 tax cuts, we're not seeing an appreciable deviation around that 12%. In fact, you look at Wall Street surveys, you look at the Atlanta Federal Reserve survey, you look at the hard data, and it breaks down this way. What corporations did, particularly public corporations did with the freed up cash, was buy back their shares, publicly traded shares. Perfectly logical, rational thing to do, but it had very little upside ripple on the macroeconomic scene, right? About 25% of the money went toward pay raises, bonuses. That has more of an economic ripple, and only 25% went toward CapEx. And there's no follow-on to that. I mean, that's a one-time deal. Now that cash flow is normalized. So we're not about to repeat that effort just because the tax law is there, particularly since most business people know, they're savvy enough to know that in 2 years that could be taken away from them. Part of what ties into our rather concerning outlook for 2022 is knowing that in 2021, 2022, a lot of today's upside tax benefits are going to be withdrawn. That's a very high probability. And whatever positive benefit we have been deriving will be withdrawn from the economy, and you'll have a natural adjustment to that.
The business cycle will affect more than just the U.S., given that 8% roughly of GDP is derived from exports, in combination with mounting international trade disputes. Do you see the government currently accelerating this business cycle or magnifying the possible effects?
Generally, governments are reactive, so they tend to be almost an afterthought when it comes to forecasting. This round of trade tariffs is different because in the annals of U.S. economic history, we've never imposed trade tariffs when we're at the top of the business cycle. We've always imposed tariffs to try and create American jobs, which tariffs tend to do. But why are we trying to create jobs when we have a job shortage? Why are we trying to create jobs when we're trying to limit immigration? Fortunately, in the State of the Union address, President Trump now says he wants to invite more legal immigrants in here. First time he's ever said that. I hope he means it. But you don't go creating jobs or the demand for jobs when you're at the top of the business cycle. All you're doing is increasing inflationary pressures. Now I'm getting to answering your question. Distorting the supply chain is only increasing the pressure on businesses that were single-sourced, either domestically or abroad. Normally that isn't an issue because you're at the bottom of the cycle. You have lots of capacity. That isn't true. We are not looking at excess capacity globally in many, many markets. So the impact of this is heightened inflationary pressure down the road, leading toward even higher interest rates than we other would have seen. I think, therefore, it's an exacerbating factor for the 2022 downturn. That's how you're going to see it ultimately get played out.
And that 2022 downturn it'll affect more than just the U.S. And so do you see some countries, whether it's Europe or South America or China, that are really in a more vulnerable position and that obviously would have ripple effects from an international trade standpoint?
Clearly, it will be a global cycle. All the major players of the world are linked. It's one geosynchronous business cycle. We no longer find significant lead lags between economies. Heading my list of concerns, not only for 2022, but beyond 2022, would be China. Not only do they have a real demographic problem, but they have a real debt problem. They're much better at us at hiding their debt problem, but it's very real nonetheless. And the new change in power structure within China meant that they're moving back toward funneling resources toward grossly inefficient SOEs instead of feeding the capitalist side of their economy. It's a very negative sign. Europe scares the daylights out of me because their demographic is grossly negative in too many areas, and because they have social costs that could crush just about anybody else. Thank goodness for the Germans keeping Europe generally on its feet at this time. Brazil is going to not be in appreciably better position come 2022. Brazil always, when we catch a cold, they catch the flu, so Brazil is going to be hard hit, which means South America is going to be hard hit in 2022. Countries that I look for as better than normal upside opportunities, and it's not politically cool to say this right now, would be Mexico. I love what's going on in Mexico. I think Mexico's growing middle class, their growing population base, their ability to harness natural resources, their untapped natural resources, their latent ability to do that, phenomenal upside opportunities as we come to realize that they're a trading partner, that they're not an enemy to be feared, they're a partner to be brought into the fold. On the other side of the U.S. MCA agreement, should it ever get signed, you'll have Canada, and Canada falls more into the Europe camp. In terms of the spectrum of upside opportunity, Canada is leaning more toward going the way of Europe, whereas Mexico is leaning more toward the way of going with the U.S. economy. Make no mistake about it, and this isn't just U.S. hubris, and I say that because there are 7 countries represented here. The U.S. is the world's dominant economy. We're at 24.2% of the world's economy. Number 2 is China at about 15%, and they're never going to catch us. Number 3 is Japan, and they're shrinking. Number 4 is Germany. We are head and shoulders the 800-pound economic gorilla, and that's going to be the case for the next 100 years. For 3 reasons. 1, demographics. Our population is growing in the United States. That is so fundamentally important if you're going to grow an economy. Organic growth happens when your population is growing. You have a second hand on your watch and you listen to an economist. It's boring, so tick off 13 seconds. Every 13 seconds in the U.S., whoop, there's a new person in the United States. That's what happens when you net out births, deaths, and legal immigration. And if we open up the immigration portals, it'll probably shrink back down to 12 seconds. Every 12 seconds, there'll be that whoop. I call those instances FCU moments, future consuming units. And when you have future consuming units, your future looks good. China doesn't. China doesn't have those future consuming units. Japan doesn't. Europe doesn't. We do. That's one of our strengths long term, even, and you've read our book, Prosperity in the Age of Decline, even after we're going through that demise, we emerge from that downturn looking so prosperous, so strong, because we are going to be so young compared to them, because the millennials define that generation. They're amazingly big. They're the biggest generation we've ever seen. Here are the baby boomers, right? Then Gen X, relatively small, relatively quiet. Then we have these tremendous millennials, and underneath the millennials we have Gen Z, which has a whole lot of potential all by itself. Most of our trading partners have this inverted demographic pyramid. Top heavy with old people. We're not that way. We have these beautiful hips that are sustaining us. Bring on the hips, which is beautiful. We also have natural resources. I mentioned before the age of inflation that is coming upon us. Countries, just like businesses that harness natural resources, investors who invest in natural resources, countries that own the natural resources win. It's very clear. We have been mightily blessed with those natural resources. Oh my gosh. Compared to China, there's no comparison, really. Which is why China is buying all the rare earth mineral mines it can, why it's colonizing Africa, why we're so slow to do that, because we have so many natural resources here. It's one of the things I love about Mexico. But India has growing population, India has natural resources, but they're still not even in the top 5. Why? Because India fails on the 3rd criteria, as does China. The 3rd criteria that makes us different is the rule of law. You have to have the vibrant rule of law, adjudicated law, not political law. And that law has to protect property, real personal property rights. You have to protect the intellectual property, which is what our current round with China is all about. And you have to have legitimate bankruptcy laws. If companies can't fail forward, then they'll stop moving forward. We learned that a long time ago. The United States is the only country that passes on all three of those measures. India fails on the rule of law. They can get there, but they're not there yet. Why does this matter? Because if I was looking for distressed investment opportunities, I'd be U.S. or U.S.-Mexico-centric. And beyond that, I'm trying to save you some time. Stop reading all the books and the magazine articles that equate the United States to the Roman Empire or the Byzantine Empire or some other empire. We are not them. And third, if you have adult children living with you at home, kick them out. Come on. You can make it. This is the world's #1 economy. Looking good. Move. Make it happen.
Yeah, it's a great comment.
You touched briefly on mounting debt. So our country's debt has been mounting. Do you believe that we're going to see a tipping point in the next couple of years that's going to lead to some of this downturn, or are we, from a debt management standpoint, still in a healthy standing?
We're still in a healthy standing when it comes to our national debt in that we can finance it, and others are willing to finance it. But the trend isn't healthy. If you look at our national debt not our national debt, total government debt in the United States as a percent of GDP, we're at a post-World War II record high and climbing. The deficit in the last fiscal year underneath an ostensibly conservative president and a conservative Congress increased 17%. When interest rates go up, servicing this increasing amount of money that we owe becomes more and more onerous. Right now, we're at about a pace of about $575 billion, with a B, goes toward interest payment on the debt. That's $575 billion they need to tax from us, or they're not going to spend on defense, or they're not going to spend on social programs, or they're going to print. It doesn't have to be that way. Other countries have found a way to mitigate some of that damage. Here in the United States, so far, at least culturally, we haven't figured out how to do that. Some people like to ask, is there a dollar amount or is there a percentage with the national debt that once we reach that, you know we've gone too far, Brian. You know that the end is nigh upon us. And the answer to that is no, there's no magic number. I've looked for that. I'm not so bad in math. I've looked for that. I've tried to develop an algorithm that looks at all the relationships globally that says, okay, once we cross that line, we've gone too far. Because it isn't a number, it's more emotive than that. And that's why the tariffs scare the daylights out of me. We have crossed that line when our trading partners are no longer willing to lend us the money to continue to feed our hungry beasts, to continue to feed our lifestyle, to continue to feed our needs. That's when we've gone too far. And there's no number that's going to tell you, well, at this particular point in time, that's when it's going to happen. All I know is that when they no longer have a vested interest in keeping our economy going because trade with us has largely disappeared because of nationalism, which is a global trend, not just a U.S. trend, then you're setting the stage for when that day comes. But no one knows exactly when that day is going to be.
Not even you?
Not even me, no.
So domestically, ever since the last correction, traditional bank financing has been less scarce. It's been less available, especially in the mid-cap and smaller mid-cap markets. And it's led to a rise of alternative unregulated financing. I'm curious as to what your thoughts are regarding that and whether or not you see that as a benefit to future growth or a threat to the future cycle and downturn that we're about to experience.
It doesn't have to be benefit or threat. It can be benefit and threat. But let's back up one moment and talk about why this alternative financing channel arose. It was one of the unintended consequences of the Dodd-Frank legislation. I'm, I guess, a libertarian if you want, but I'm more of an Austrian economist. Government intervening in the marketplace invariably creates unintended consequences. One of the unintended consequences of Dodd-Frank was we see home prices rising at a very brisk pace through most of this country. Another one is we had to find an alternative means of financing our growth, which is what you just referenced, Adam. It is a benefit because the need is there. It's a benefit because we found a way to deploy the capital, and we live off deploying capital. We are a capitalist economy. We do not want the government handing out that capital. But the risk comes when we're chasing the returns And when the ability to pay back that money evaporates, and the revolving door that covers that debt, that drove down the ratios in terms of ability to pay, disappear, then we find, well, the emperor didn't have nearly as many clothes on as we thought.
Thank you. ITR is projecting in your book, which again everyone should read, a correction in the decade of 2030 to 2040 that will rival the Great Depression. Can you describe some key indicators which led to that prediction, or expand on that prediction a little bit more?
Sure. First, a show of hands, if you don't mind. How many of you in this room are over 57 years old? Would you raise your hand for me if you're over 57? Excellent. You don't need to care about this. All right? You'll be retired, or you'll be on the wrong side of the grass before it hits. So not your deal. How many of you are under, say, 44 years old? Raise your hand if you're under 44. All right. Sucks to be you. All right? Because this is going to hit you square in the face. All right? And what's driving this is it's a compound phenomena. Like most big events, there's some trends coming together. There's a confluence of events and trends, unsustainable trends. One is demographics. We are getting older. The good news is that in the United States, the majority of us baby boomers will be dead by 2036, and the population gets a reset back toward a younger average age, different mindset, different people in power rather than just old people continuing to be in power. But until then, we have more and more old people, and there's lots of benefits to older people, but from an economic standpoint, remember, economists don't have a heart, they really don't have a soul. Old people just suck the life out of your economy. They take, and they put back very little. Okay? That's a burden that we have to bear along with the rest of the world. But here in the United States, we have this Social Security nonsense to contend with. Anybody who knows basic arithmetic knows how to fix Social Security. Our issue here in the United States is there is zero political will to fix Social Security. And that ties again into the demographics, because there's no political hue and cry to fix that, because there's more old people than there are people close to having to worry about that. And this gets me kicked out of a lot of stages across the country, but you know, just because it's been one way for all these years doesn't mean it has to continue that way. Deming, the great management guru, one of my heroes of the past, he once said, "It is not necessary to change. Survival is not mandatory." All right? We have a system that we can't afford anymore. Changing that system is now mandatory. But we have zero political will. By the way, in a lot of the companies I assume you're investing in, you're going to find that exact same phenomena, that same ethos. I don't need to change. I've been successful. I couldn't possibly see this coming. I've never encountered this before. How would I know? That sort of thing, right? It's because you constantly need to be evolving. You constantly need to be changing. The other major culprit that we're looking at is our healthcare system in the United States. Some people like to say, well, if we had a single-payer system, it would be all better. If we simply used the government to negotiate down drug prices, it would be all better. If we made hospitals go electronic, it would all be better. If we allowed the consumers to see the real cost of what they're spending money on, it will be all better. And I look at all those things and I say, those are great exercises, folks, but they're not going to fix the problem. See, it's a supply and demand problem. The supplier and the consumer, they never touch. Whether it's a single-payer system or the current insurance system, or whether you know you can get it more cheaply down the road, if the money's not coming out of your pocket, what do you possibly care how much it's going to cost? I'm going to go where it's convenient. I'm going to go to the best doctor. What do I care about how much it's going to cost? There is no connection there. And until we find a way to make it a connection, we're not going to fix the system. Here in the United States, relatively unique to the United States, we have this culture that if we spend enough money on a problem, we can solve the problem. We don't have to face that problem. We view death the same way. We continue to spend 80% of our healthcare dollars in the last 2 years of an individual's life. And if that's my wife we're talking about, it's worth it. If it's somebody else's person, to me, it's not worth it. Right? If it's my first wife, not worth it. We can save some money here. Okay? Can we vote on this? You see what I mean, though? We don't want to make that call. We will spend money because we think we can cheat death. Death is not part of our culture. Every death is treated as a tragedy instead of a passage. And until we change that facet of our culture, how on earth are we going to possibly change how much health care is costing us in the United States?
On that note, what do you think the effects recently of either Obamacare or Trump's version thereafter? Has that made things worse? Has that made things better? Is it kind of a push?
It's a push. All we're doing either with Obamacare or Trump Care is we're just moving the cheese. We haven't fundamentally changed much of anything. We're still out of step with the demographics, the need. I don't like to delve too much in history, but I remember 20 years ago talking to businesses and telling them, look, you poll your employees, man, and they're going to tell you that health care is a right that they have. And as soon as it becomes a right that they have, you are cooked. And as long as government expects you to fund their right instead of the government funding their right, then you're going to be looking at a cost squeeze that you somehow have to contend with. And FYI, by the way, and this is a short-term business cycle phenomenon, healthcare costs in the United States, in particular employer-paid health insurance costs in the United States, have ramped up over the last 3 to 6 months, and they're going to be ramping up like that for the next 2 years. They had been stable for a while. That's come off, and we're back to ramping it up. And while some people are going to blame it on Trump Care versus Obamacare, that's just circumstantial. But we're going to see more and more businesses where these healthcare costs are going to become something that they can't adequately fund.
Back to Social Security, you said that anyone who's a student of arithmetic realizes that we have to change the system that we have. If we had the political will, which we all acknowledge that we do not, but let's assume that we do, is there time to make those adjustments, whether it's raising the retirement age, raising taxes to fund it, changing benefits under the program, or has that ship sailed?
I am, despite the words that have come out, I am by my nature an optimist. But I also know how to run numbers. So I'm careful to distinguish between those two when I answer your question. When I run the numbers, there is time. We can still avoid this 2030 phenomena. We can at least take the Social Security aspect of it off the table. We can still fix healthcare. There's still time. It is just my opinion that there's zero political probability of that happening. All you have to do is look at the last 40 years. Different administrations, different philosophies, and you know what the trends are. And all of a sudden to say, well, now we're going to understand these trends and we're going to veer off this course before the pain is here. Understand what it means? It means that our politicians have to say, look, we're going to take some short-term pain here, folks, but there's long-term gain. We're going to avoid all this pain down the road. And you're still going to re-elect me in 2 years or 4 years because I'm doing what's right for the long term. We're not set up to do that. We're not equipped to do that. The American people don't want to hear that. What they want to hear is that they're going to get more free stuff. That's what they want to hear.
So I have one last question for you, and then we're going to turn it over for Q&A for anyone who has any questions for Brian. But I think there's a lot of us in this room who are wondering, what can be done to maximize wealth between now and 2030? And what can be done to protect and preserve wealth in that decade of decline that you're predicting?
You have to be, between now and, say, 2030, 2029, investing into those 3 areas that I talked about. Use to your advantage our natural advantages: demographics, natural resources, rule of law. And to me, that breaks down into I'm going to avoid a lot of fixed income investments unless that fixed income investment can function like a traditional bond ladder would as interest rates are going up. So I'm going to overweight equities a little bit more. But in particular, when you look at how many more Americans are going to be running around and they all need a place to live, I'm overweighted personally in real estate, and I'm overweighted in commodities because commodity prices do very well during extended periods of inflation. So I'm breaking some of the paradigms of the last 30 years, recognizing that the paradigm of the last 30 years was set up by globalization. And globalization is dying. So my new investment paradigm has to be toward what's driving the next 12 years. And that's going to be this inflationary move. Sometime around 2029, sometime around 2030, you got to flip. And the trick is going to be knowing when you have to flip. And other than to continue to attend these conferences, and you invite me back to these conferences, I'm not sure how you're going to know. But I know this, you're going to hear more and more frequently the four most fateful words in finance, and that is, it's different this time. When that's on everybody's lips, it's different this time. Oh, don't worry about that, it's different this time. It's not different this time, folks. History never repeats itself, you're absolutely right, but history sure likes to rhyme. You know what hasn't changed this time? People and what drives us. We just find different ways to accomplish the end means. So you're going to flip, and you're going to sell your real estate. You're going to keep one big house because that one big house is going to come in handy because the kids are moving back in with you. All right? You're going to eschew your stocks, most of your real estate. You're going to have sold off your commodities, and you're going to buy government bonds, but not the U.S. government bond, because we are going to be one of the epicenters of the problem. It'll be a global problem. You're going to go to a Swiss government bond, Australian government bond, and Canadian government bond. Those will be the three pillars of your investment portfolio. You're going to be buying at a time when interest rates are very high, so the interest income off those bonds is going to be very nice. And because the interest income is very high, the interest rates are very high, the coupon rate is very high, theoretical coupon rate, those bonds will be called, and they're going to be called around 2035-ish, maybe 2036. So you're going to have an influx of cash. You're going to take that newfound cash and you're going to start investing in hard assets again. Forget about gradualism. Between 2029 and 2036, there is no gradualism. You're all in. All right? And you got to be willing to make that move as it shows itself. Most people will not. Help your kids through this period, by the way, if I may do a public service announcement. If you have children or grandchildren still in school, somewhere in the school system, help them. Show me an American who's bilingual, and I'll show you an unusual American for one thing. The first language they should learn is proper English, like proper. The second language, I think, should be French. French language is ubiquitous. Every place a French Foreign Legion has gone, they know French. So in Asia, Africa, Europe, they generally know French or English. I happen to think that Africa has an incredible potential if they could ever get their law portion squared away. They score very high on the other two factors. If they ever get the rule of law in Africa, I want my grandchildren to be able to do business there. And they're going to be able to do business there if they are bilingual, and help your kids or your grandkids be strong in math. Strong in math, bilingual, you're always going to have a job. I think during the 2030s, we're going to have an unemployment rate in this country that's going to be like 20% unemployment rate. And for economists who think on the margin, that's devastating. I choose to look at it the other way. I am busy preparing people to be part of the 80% that always has a job, that is always accumulating wealth, that is always making the system work, because they are, as the TMA spokesperson was saying, facing forward. They're seeing the future before it's here, and they are prepared for that future. Best way I can wrap this up, and I know we're out of time, so please forgive me, but my generation, we did a terrible thing. We told our kids, just go to college. It doesn't matter what you study. It's important that you get a college degree. What dumb advice that was. Dumb. You want to know the difference between an art history graduate and a park bench? The park bench can support a family. This cannot support a family. That's the difference. Adam, thank you very much. Thank you all very much.